All right, we're recording. Lee. Hello, everybody. Welcome. Thank you for being with us today. I'm going to give it a minute for everybody to populate the Zoom. We're glad to have you join us as the Zoom populates here. And a little Zoom housekeeping that you're all familiar with. For the record, we are recording this. We can't see or hear you, but you're welcome to, and we encourage the questions through the chat box and the Q&A, whatever is comfortable for you, or depending on how you're dialed in here. We are fortunate, and I mean that, I have no reason to suck up to Lee here, to have him again. A couple months ago, he had talked to us about his business, and we welcome him back. And I'm glad to see that we have quite a few more people that hadn't been able to join last time. So you are all welcome to, as I mentioned, ask questions as we go along here. We'll get to as many as we can. And as you know, I'll be thinking about some questions as we go along and do the same thing. You can raise your hand in the Q&A or in the chat box. I'm going to say hello in the chat box to you all. If someone would just reply back so we make sure we're broadcasting. I'm not going to tell Lee's story. He's going to share it with you now. And Lee, welcome back.
Arthur, thank you very much. And thanks to all of you for joining to hear a little bit more about SharpVue Capital and about the Southeastern growth story. I'm based here in Raleigh, North Carolina, fast-growing market in a fast-growing region. And I started the firm 5 years ago. We focus exclusively on the Southeast. Within that, we're quite diversified. And so I'm going to walk through a slide presentation that tells you about what we see as our competitive advantages, the growth story of the Southeast. I'll talk about a few deals in particular and look forward to answering all of your questions. So hopefully everyone can see my screen.
It looks good.
Great. And so again, we're SharpVue Capital based in Raleigh, North Carolina. And when I think about our firm, I think of us as having four distinct competitive advantages. One is that we're local. We're embedded here in these local real estate markets. Headquartered in Raleigh, I've spent my career focused on these markets. I was born and grew up within our footprint here. I went to college here in the Raleigh-Durham Triangle, went to Duke University, and I've been here in Raleigh specifically for about 15 years. The rest of our team, all deep roots in the Southeast. We see a lot of investors coming into our markets from outside, and many of them are paying too much money for the wrong asset in the wrong location with the wrong partner. And we don't want to be that investor in markets that we don't know and understand. We think by being local here, by being embedded, we can find deals more quickly. We can find deals that others aren't necessarily going to find, and we can underwrite them more effectively. I think our second competitive advantage is that we're highly diversified. So we're diversified by real estate product type, by where we are in the capital structure, and by stage of development. And so I think that's important because if you think about a fund that can only invest in one real estate product type, they have to invest in that product type at every point in the cycle, whether or not it's a particularly attractive point in the cycle for that product type. All they have is a hammer and everything looks like a nail. Because we only focus on the Southeast, we think we can effectively move across property types, and we've done that since inception. And when I say we can invest anywhere in the capital structure, we can be a bridge lender, a mezzanine lender, a preferred equity investor, a common equity investor, a GP co-investor. We've done all of those structures. And that's important because we find all of our own deals. Many of them are just situations when we find them. They're not necessarily even deals. And by being able to enter a particular situation at what we think is the most attractive risk-adjusted return piece of the capital structure, we think that makes us as more effective than an investor who can just do mezz or just do equity. And I'll give you some examples of that as we move through the presentation. Thirdly, we're deeply networked in these markets. We find all of our deals through word of mouth and personal networks. We don't compete for deals. We see all of the emails from the brokers, but we don't find our deals that way. If you're buying deals at auction, which is what you have to do if you're not plugged into the local markets, then you have to pay more than anybody else thought the asset was worth. And that's a tough way to outperform. In the vast majority of our situations, we're negotiating with sellers who are negotiating exclusively with us. Again, in situations that we have found ourselves. Sometimes there's an intermediary involved, but we never compete for deals. And I'll give an example of that a little bit later on. And then fourth, we're in what we are confident are superior markets, the growth markets of the Southeast. So our footprint here, the U.S. Southeast, everyone's familiar, I think, with what's been happening here over the last 10 or so years. We've grown at twice the national average. We're expected to grow at twice the national average over the next 10 years. Pull out a couple of markets that I'm sure everyone's heard something about. The Raleigh-Durham market, where we are, the Charlotte market, the Nashville market, they're all about 2 million people. And the Raleigh-Durham market is driven by education, healthcare, technology, and government. You've got 3 major research universities here in the area, including Duke, my alma mater, Chapel Hill, which is the alma mater of some folks here on the team, North Carolina State. Duke believes that it is the largest recipient of federal research funding after the U.S. National Institutes of Health. And that the other big research universities here receive similar levels of federal research spending and other grants. So you have a lot of money coming in for high-end research, a highly educated population. The nation's largest research park, the Research Triangle Park, has really driven growth here in this region. Charlotte has become an important Fortune 500 headquarters location. 8 Fortune 500 companies based there. It's become a significant financial center. So if you think about the 4 biggest banks in the United States, one of them is headquartered in Charlotte. A second has its East Coast operations based in Charlotte. And there's a third bank, which will be the 9th biggest bank, the product of 2 smaller regional banks coming together, will also be headquartered in Charlotte. And you've got 3 major asset managers based in Charlotte. So it's becoming a significant headquarters hub, and particularly a financial services hub. And Nashville is kind of a combination of Charlotte and Raleigh. You've got the education component and the healthcare component, but it's also an important headquarters location. And then in addition to Nashville, you've got the entertainment and tourism factor driven by country music and the entertainment industry more broadly. So the whole area is growing. There are other markets that maybe you haven't heard as much about, like Greenville, South Carolina, which we think is a very attractive market. You've got 2 big interstate highways coming together there. You've got several universities. It's right in between Charlotte and Atlanta. BMW put its first manufacturing facility outside of Germany there a couple of decades ago now. A lot of suppliers coming in, including Michelin Tire, to support BMW, and that area continues to grow. And we'll talk a little bit more about other deals that we have around the Southeast. I'm sure most of you have seen the ULI PwC markets to watch. Our markets always feature very prominently in this list. The list that just came out a few weeks ago was even more favorable for our target markets than the previous lists had been. You see it's really dominated by these Southeastern markets, and then by a couple of Texas markets, and Texas is not a part of our footprint. Again, we focus on markets that we know and that we understand, and we're gratified to see them listed as markets to watch, some of the best markets in the United States. I talked about the population growth over the last 5 years. This is U.S. Census data. So our markets have grown significantly faster than the United States over the last 5 years, expected to grow about twice as fast as the rest of the United States over the next 5 years. And part of that is a very business-friendly environment. And one of the most important, not the only, but one of the most important attributes to that is just a very favorable tax rate. So you see the average individual tax rate compared to the U.S., 3.7 compared to 6, and average corporate tax rate significantly lower than the U.S. average. So that's our target markets compared to the U.S. more broadly. I've spent my career in real estate investment and finance, with the exception of a brief stint before founding SharpVue, when I served as the budget director for the state of North Carolina, about 18 months as budget director, 2014 through 2016. And one thing I saw there was the degree to which states in the U.S. Southeast compete with each other for corporate relocations. And that has the effect of keeping public policy in each of the states in our footprint very business friendly, very accommodating, because no matter what happens at the political level, if you're in the government of the state of North Carolina and you're competing for an important corporate relocation, you know for every single prospect you're competing with South Carolina, with Tennessee, with Florida, with Georgia. And if your policies, if your public policy becomes less competitive than those neighboring states, you will see the impact immediately in terms of lost business. And so that I think should give investors comfort that these business-friendly conditions aren't going to change anytime soon.
Lee?
These are the best states for business in the Forbes ranking. Again, the Southeast performing very strongly. North Carolina, our home state here, #1 overall in the Forbes rankings in terms of best state for business. Virginia, best in quality of life. Every state in the Southeast performing very strongly in this regard. And then the kicker, I think, is that we have significantly higher cap rates. So our target markets are in blue, gateway markets in red, and you get all of the growth that I just described with better value and better yield. And I think that's, if I were to use one chart in my presentation, this would be it, because I think it sums up what makes our market so compelling. Significantly better growth than the U.S. average, but with better value and better yield. So I'm going to talk a little bit more about a few specific transactions. This is a deal in Charlotte, North Carolina. You can see from the map here that it is just outside the central business district, which is represented by the ring road that you see in the mustard color there. So it's very much of a transitional neighborhood when we went into the deal. And I think it's a good example of our ability to effectively price risk and enter the deal at the most attractive place in terms of the risk-reward trade-off. So off-market situation, we heard about it via word of mouth. The developers had the site under control. It's an old mill, but they didn't have the capital to acquire the site and do the pre-development work. They had about half the capital they needed. So we put in a 50% loan-to-value, day one loan-to-value. Loan-to-value goes down as they acquire the site and do the pre-development work. But put in our 50% loan-to-value convertible bridge loan that allowed them to acquire the site, do the pre-development work. Our loan was convertible to mezzanine debt at our option once they were eligible for a traditional senior construction loan. And you can see just outside the central business district here, and as you can see on the map, the light rail, which is directly above the property on this map, directly to the north of the property, the light rail, when we went into the deal, was scheduled to begin running along the back of the property. It hadn't started running yet. You had a bunch of boarded up houses around the asset, this old mill building. And we thought, and the developers thought, given that it was an old mill, exposed brick and beam loft type office space, given that it was kind of a transitional neighborhood, that the most likely tenants would be creative class tenants, little local ad agencies or design firms. Instead, Duke Energy, a large publicly traded power company, came in and took all 92,000 feet of the office space. This is a rendering of the completed mill. It came out very well, and this is Duke's office space. With the Duke lease, they signed an 11-year lease with 3 5-year extensions. With that Duke lease, the deal was obviously significantly de-risked. We converted our bridge to mezz. We added an additional slug of preferred equity to finance the build out for Duke. There's also, this is 92,000 feet of office and about 40,000 of retail. The retail is a food hall predominantly, which has performed extremely well. It's done very well throughout the pandemic. My wife was actually there on Saturday and told me they were waiting in line for half an hour. It's that crowded. This doesn't really drive the deal given the Duke lease, but it's an interesting component, I think, given the pandemic of how some kinds of retail, we don't have much in our portfolio, but this kind of retail can significantly outperform. And most importantly, we were taken out of this deal this summer by a large, I think of as very conservative German investor who paid top dollar for the deal. So I think it's an example of maybe 3 important attributes. First is our ability to find deals, word of mouth, personal networks, and enter the deal at the most appropriate, most attractive risk-adjusted return, in this case by structuring a convertible bridge loan. Secondly, by our ability to price risk effectively and move across the capital stack as the deal hit performance targets and was de-risked. So we were a bridge lender, a mezz lender, and a preferred equity investor on this deal. And third, when you have a conservative German investor coming into a market like Charlotte, they weren't even sure that they wanted to be in Charlotte not that long ago. They were focused on global gateway markets. To come into not only into Charlotte, but into kind of a transitional neighborhood. By the way, those formerly boarded up houses are now large-scale apartment projects being undertaken by national developers. So the whole area is transformed. But conservative investor coming in and paying top dollar in a transitional neighborhood in Charlotte in the middle of a pandemic, to us is a significant sign of strength and health in our Southeastern footprint and really supports our values on exit. There's another deal here in Raleigh, North Carolina. You can see its location both on the map and in the photo. This is the 440 Beltline, the main ring road around Charlotte, and then Capitol Boulevard, US 1, the main north-south artery. Sorry, I said in Charlotte, and here in Raleigh. This is an old manufacturing facility. It's about 80,000 feet of office space, which is the small building at the top of the picture, and then about 420,000 feet of warehouse space, flex space. And the office is fully leased to the state of North Carolina. It's a 10-year lease. They had signed the lease right before we acquired the deal, and the state of North Carolina is a AAA credit. That lease covers 106% of the senior debt service. The rest of the building, this 420,000 feet of flex space, is really little kitchen and bath type plumbing supply, electrical contractor type of tenants. And we love this kind of infill industrial space because the supply is at worst constant. These kinds of tenants, a plumbing supplier, electrical contractor, they can't afford to be in modern industrial space out by the airport. They don't want to be out there anyway because they want to be closer to where people live and work. They don't need modern industrial space. They need space that's got plenty of parking, has some highway visibility, has got loading docks, but also has some showroom space. And so that demand stays constant, but the supply is going down. So I said the supply was constant. I meant that demand is at worst constant because these tenants aren't going anywhere, but the supply is going down because no municipality thinks that the highest and best use for a given piece of infill real estate is this kind of flex warehouse. And a lot of it, so nothing new is being constructed. And a lot of it is being converted to loft type office space, to multifamily, to microbreweries, and to co-working. And so constant supply, decreasing demand, we've found in these projects. We have another one in Charlotte, we have another one in Greenville, South Carolina, that we're really able to drive rents because there's so little supply in the market. Another interesting thing about this deal is that it's got about 30 acres of excess land, which you see in the blue on this page. We didn't pay for this land. In effect, we bought the deal off a cap rate basis. So we got the excess land for free. And it's a good example, I think, of how we underwrite deals, because the base case for this deal was a very standard value-added play where we move the existing tenants into a smaller footprint, we raise the overall rental rates, we bring in new tenants, we lease up the vacant space, and then we sell it. But there's a home run available if we redevelop this excess land, particularly the frontage up there on Capitol Boulevard. So in all of our deals, we try to make sure we have strong downside protection, in this case represented by the state of North Carolina AAA 10-year lease covering our senior debt service, a base case that is a strong return that achieves the objectives we set out to achieve for our investors. In this case, a value add strategy of leasing up and repositioning the asset, raising rental rates. And then a home run case, which if everything works out, we're not counting on that, but is available, in this case, developing the excess land. We are bringing this asset out for sale in the first quarter. We have gotten a considerable amount of unsolicited inbound interest, which I think again points to the strength of the markets in which we're operating. It is a highly visible asset, and so we've hired a broker and started the process to begin marketing, and we'll push the button on that in January. The unsolicited offers that we're getting are well in excess of our original underwriting on this deal. And then the last deal I've got slides on to talk about specifically. I just thought it was interesting for the group. This is Volano Beach, Florida. It's outside of St. Augustine. It's part of the greater Jacksonville metropolitan area. This is a hotel, and I think it's a good example of how the pandemic can have a widely varying impact on assets, even within a sector like hotels, which have obviously been very hard hit. So this asset is it's a Hampton Inn. It's the only flagged hotel in this little submarket of Volano Beach. It's really nothing particularly special. It's 94 rooms. It's a classic value add play. It needs a renovation, so it's not necessarily up to what either Hilton or today's hotel guests expect from a Hampton Inn. So we acquired it knowing that it needed some work. It's right on the beach. So this bottom photo here is taken from the hotel. That's our parking lot between the hotel and the beach. And you can see kind of a standard older generation Hampton Inn type of upfit. But what's interesting about it, it's performing better than, it's having its best year in the operating history of the hotel. And that's because it's in this drivable location, highly accessible by car to much of the Southeast. It's not very expensive to get there. It's not a very expensive hotel, but it is the only flagged hotel in this submarket. So it's on the Hilton reservation system. You can use your Hilton rewards points to stay there, unlike the mom and pops that surround it. And it was at 50% occupancy last night, a Monday night in November. It's continued to outperform and perform far beyond what we expected. The beaches have been open almost throughout the pandemic in Florida. The theme parks have been largely closed. And so I think a good example of how even within a hard hit sector, you can have particular assets that can outperform. We also have a little bit of group business at the hotel, which is especially unusual in the current environment. where we have some government and trade groups coming in for small sales conferences and training sessions and things like that. So those were the slides that I had prepared. I'd like to talk a little bit about what we're seeing in terms of deal flow and with some of our other assets. With respect to deal flow in general, as sellers, it's very positive. I mentioned the Optimist Hall asset. I mentioned the Capitol Boulevard asset that we're going to market in Raleigh. We have another flex asset in Charlotte that's going to sell here in about 3 weeks, significantly above our underwriting. We're bringing an asset in Wilmington out to market. So we're seeing a significant willingness of buyers to pay pre-pandemic pricing, in some cases beyond pre-pandemic pricing, for assets in the Southeast. And but conversely, and so that helps us as a seller, obviously. Conversely, as a buyer, as an investor, what we're seeing is not a wave of deals. There were relatively few deals available in the second and third quarter. We're not willing to pay pre-pandemic pricing as an investor. We want to find deals that reflect dislocations born of the pandemic. We did one deal in the second quarter, which I characterize as a true distress recapitalization, a deal where they needed to recap before the pandemic hit. They were going to do it with a consortium of community banks. And then the pandemic hit, the community banks got distracted. The borrower still needed to recap. Now it was an emergency. Again, very tactical, word of mouth situation. We were able to put in a small short-term bridge loan, very attractive terms, excellent collateral, again, highly opportunistic. What we're starting to see more of as we move through the fourth quarter is that a lot of lenders are beginning to think about rationalizing their loan portfolio. So back as the pandemic was taking hold 6 months ago, forbearance was pretty much generally available for any borrower who asked for it. We have got an asset in Wilmington, North Carolina. It's our most stabilized asset. It cash flows extremely well. All it does is stay fully leased. It's a 75,000 car a day intersection. And we have 2 community bank loans on that asset, and the community banks called us up and asked us what kind of forbearance we needed. We didn't need any forbearance, but it shows how widely available forbearance was at the beginning of the pandemic. I think now as those forbearance periods are rolling off, some borrowers won't need additional forbearance. Some borrowers will need it and will get it. But I think banks and lenders more generally will start to discriminate a little bit more among their borrowers. Maybe they were worried about a loan before the pandemic. Maybe they weren't happy with the performance or with the borrower. I think as we move through the fourth quarter, we're starting to see lenders look to rationalize that portfolio and start to sell loans. And we have a lot of experience buying loans, a lot of experience with distress. We're already seeing interesting opportunities. We're going to see more. I'll give an example of a kind of deal that we're working on now. This is a deal in Atlanta. It was 58% leased when the current owner bought it 5 years ago. They got it up to 90% plus leased. They took it out to market in February. They had to pull the deal in March, given the pandemic taking hold. And so now they need to hold it through another leasing cycle. It'll be another year or two, they expect, before they take it back out to market. So now they can extend the senior loan, but the mezz lender, the existing mezz lender, isn't willing to extend because the mezz loan is in a fund that's winding up. So they need a new mezz loan. They need more mezz because now they have to hold it through another leasing cycle. They need money for tenant improvements and leasing commissions. We can put in a mezz loan at about 10% of the capital structure, very attractive terms with a make-whole provision. So even if they pay us off more quickly than they think, we still earn the returns that we're underwriting. That's what I mean by trying to find deals born of the pandemic. Another example would be a convertible bridge loan similar to the one we exited in Charlotte. This is a another piece of land in Charlotte. It's zoned for very dense multifamily development. The borrower is a consortium between a big New York investment fund and a high quality developer. Land loans are not as widely available now as they had been in the past. So we're able to put in, again, a low leverage convertible bridge loan, allows them to acquire the site, do the pre-development work. Our takeout will be the traditional senior construction financing, and we have the right to convert the bridge to mezz at our option as they become eligible for more conventional senior construction financing. We're investing about $4 to $15 million per deal. That's a great size for us. There's a little bit of a gap in the market, and there's obviously a lot of capital chasing deals across the board, but at that particular deal size, there is a little bit of a inefficiency in that friends and family capital kind of caps out at $3 to $4 million, at least in the Southeast. It's hard to pass the hat for more than that. And then the big institutional investors who are increasingly stomping around our markets, they want to put $15, $20, $25 million to work at a time. So particularly for the more sophisticated structures like convertible bridge lending, we don't see a lot of other folks putting out capital in those structures at our deal size in the Southeast. I see a question here about CMBS hospitality delinquencies and the ability to acquire hotel loans from either hotels or hotel loans from CMBS servicers. And the answer to that is yes, absolutely. So we are starting to see those come to market. There's a North Carolina-based bank that put a big portfolio, relatively for the market, a portfolio of hotel loans on the market recently. There wasn't a whole lot of distress in that portfolio. I think they were just trying to lighten up on their overall hotel exposure, and I think that traded at about 94, 95 cents on the dollar. We're not going to compete at auction for deals, period, and we're especially not going to pay that kind of pricing. But I think that was the first indication that you are going to see many more of a first indication of a trend that I think you're going to see many more examples of these distressed hotel properties coming to market. I see a question here about whether or not we are more of a lender or more of a principal buyer, and the answer is that we're both. So I've given some examples both of deals where we have acted as a mezzanine lender or as a bridge lender, but in our Capitol Boulevard deal that I mentioned, in the hotel in Florida that I mentioned, we're a common equity investor, and we're equally comfortable in the secured positions as well as investing as a common equity investor. And again, just trying to find what we think is the most attractive risk-adjusted return position in the deal. That Capitol Boulevard asset that I mentioned is also a good example of finding a deal where there was a marketed situation. It wasn't purely word of mouth, but where we paid the price that we thought the asset was worth. So it was marketed for sale. It was under contract at $42 million. We knew the seller they had made clear that they wanted to sell by the end of the year. This was in 2017, August of 2017. And then we heard scuttlebutt in the market that it had fallen out of contract. And so we went to the seller and said, we understand it's fallen out of contract. We're willing to buy it. We can perform by the end of the year, which we understand is important to you. Our price is not $42 million, it's $27 million, but we can get it done by the end of the year. And we were able to buy the asset at our price. So that's an example of us finding a deal where there is a marketed situation, but we're paying the price that we think the asset is worth and not competing on price. So that can be another way of finding deals as well.
Lee, thanks. That was very helpful and comprehensive. There might be others thinking this. If you go outside of New York City, if you live in New York City, it's pretty dramatically one way, meaning the impact of the COVID and the epidemic and so forth. And so if you travel about in other places, it often is surprising that people are going out to dinner and convening together, and while being mindful, presumably, or not, that it's sometimes surprising, depending on where you are in the country, on the behavior of people. And I'm not criticizing it, I'm not making a comment about, but I'm wondering whether that's made, is that an observation that can share with us, that people are going about their lives in your region as opposed to, staying in our basement apartment in New York City?
Yeah, I think that's true. So I think you've seen that in national press coverage, but I also think we see it in just going about our normal business within the markets that are in our footprint. So I mentioned that food hall in Charlotte. They were closed down by government edict early in the pandemic, but then they were able to reopen for takeout. And takeout actually works great for a food hall. They're effectively takeout businesses anyway. They're not dependent on alcohol sales. They have very low overhead compared to a traditional restaurant. They've got a lot of outdoor space at that asset, a lot of picnic tables and covered courtyard space. And so in that case, the pandemic actually helped them. The only other retail exposure we have in the portfolio is this asset in Wilmington that I mentioned, where it's an office and retail asset, and it's very much amenity type retail, nail salon, hair salon, pizza place, burger place. We haven't had a single late payment, let alone a delinquency, from any of those tenants since this started. And I suspect some of them were using PPP funds to pay their rent before their business recovered, but now their businesses are open and they're doing well given their location. That asset stayed fully leased throughout the global financial crisis. Again, it's 75,000 cars a day with the right kind of tenants. And we see it in our hotels as well. So we actually own 4 operating hotels. And we have independent demand drivers at each hotel. I talked about the one in Florida. We have a Hyatt house in Nashville that's within 3 blocks of 3 hospitals. So the hospitals really support demand there. Hyatt house is Hyatt's extended stay product, and so that works well with the hospital demand. We have a hotel in New Orleans, which sounds glamorous until I tell you it's the DoubleTree at the airport. But that hotel is largely occupied by corporate customers on long-term corporate contracts. So some airlines, both cargo and passenger airlines, but more oil service companies that are using the hotel to stage crews who are moving in and out of rigs in the Gulf. I see a question here about adapting to COVID, and that hotel is a good example where they're actually using the hotel, these oil service companies that are using the hotel to stage crews who they move in and out of rigs, on and off of rigs in the Gulf of Mexico. They're taking significantly more rooms because now they want the crews to quarantine in the hotel before going onto the rigs. I'll give you an example of a building that we have in Bethesda, Maryland, which is really at the northern edge of our footprint. Happens to be a submarket that I know very well. Bethesda is a close-in suburb of DC, as I'm sure most of you know. And this is a spec office development where the equity and debt are large global institutional investors. We're a GP co-investor in that deal, which is a structure we like a lot. The developer, like a lot of developers, doesn't have the balance sheet to meet his co-investment requirement in the deal. So we help contribute his co-investment requirement. We take a percentage of his fees and his promote. So that deal, the use case, the tenant mix has really changed over the course of the pandemic. We thought that the tenants for that building were going to be tenants who are already in suburban Bethesda. The building's right in downtown Bethesda on top of the subway station, surrounded by a whole bunch of restaurants and bars and multifamily Anybody who knows downtown Bethesda knows that there's probably more restaurants per square foot there than any other place I can think of. And so we thought that would be attracting tenants in from their corporate campus product in North Bethesda or Rockville. Those tenants now think that the corporate campus looks pretty good. It might not be cool, it might not be cutting edge, but the pandemic has made them think maybe the corporate campus is where they want to stay longer term. By the same token, though, we've got significant demand from tenants who are coming out of downtown DC. They never thought they would want to leave downtown DC. These are law firms and consulting firms who used to think that a DC address was important. But now they're starting to think, if I move to Bethesda, first of all, I'll save about $1 million a year on my rent. But also, my employees don't have to ride the subway. And if they decide to drive in, they don't have to pay $50 a day to park, which is what it costs in downtown DC. So the demand for that building is very strong, but it's very different. It's coming from downtown DC instead of suburban Bethesda, very different than what we thought when we first went into the deal.
Lee, would you say that your comment earlier with regard to how the government and cities are actively pursuing corporate relocations and how robust that's been and how they have to compete against one another, is that trend consistent? Do you see them more? Is there more competition? Is there any kind of trend there? Because it just sounds like they have to be, and it might just be a flat thing. But is there more activity as a result of COVID or anything else that's going on that's causing people to move south?
There's clearly more activity as a result of the pandemic, both in terms of corporate and family relocation. So the Secretary of State for the state of North Carolina told me recently, he's in charge of economic development. I'm sorry, the Secretary of Commerce. He's in charge of economic development for the state. He told me recently that they had hit their target for the year back in the middle of the summer in terms of corporate relocations, total number of jobs. They're having their best year ever. There's a lot of companies and there's a lot of individuals who had been thinking about making the move to the Southeast for all the reasons that have been driving growth all along, that for whom it seems the pandemic has been the tipping point, the factor that has convinced them to go ahead and make the jump. And we see that in corporate relocations. We see it in terms of residential real estate too. So you hear over and over again from residential real estate brokers about the interest that they're getting from buyers coming from outside the region, principally from the Northeast and the upper Midwest. We see cars driving around the Southeast with New York and New Jersey and Illinois and Massachusetts license plates. A lot of houses being sold sight unseen. An economic development person in Wilmington, North Carolina, told me that there are 3 large projects there, master plan communities, where they're opening up the second and third phases for development, phases that they had planned to open 3 and 5 years from now because the demand is so strong. So and those are all anecdotes, but it's borne out in the data as well. If you look at the U.S. Department of Commerce new business formation data, the Southeast is outperforming the rest of the country week after week after week. It's been true since the middle of the summer. So there's no question in my mind that the pandemic has had the effect of accelerating what was already very strong growth here in these southeastern markets.
So I'm going to ask you an unfair question and to prognosticate, being that you've been in this market your entire business career, is this likely to revert to the mean, sort of come back? And it's an unfair question on purpose because you've been super nimble on your feet. I want to see how you do with this one.
So if you're asking if the relative growth of the Southeast will moderate, perhaps, but there are structural factors that make it very difficult for some other states to compete. So to the extent that taxes and overall business environment are part of what is driving people out of the Northeast, that's not going to change anytime soon just because of the fiscal situation in those states. So Illinois just had on the ballot on Tuesday, a proposed tax on the top 3% of earners. That failed, but it shows the kind of fiscal position that they're in. New Jersey has just raised taxes, and so they're really in a vicious cycle where they're losing revenue because, in large part, because they're losing population. And the solution to that for them is to raise taxes, which has the effect of making them even less competitive and driving even more residents out of state. And they do need to break that cycle at some point, but it's not clear to me how they're going to do that in a way that puts them on a sound competitive footing with the Southeast. And there are some other advantages as well. So every Southeastern state is a right to work state. North Carolina has the lowest percentage of, is the least unionized state in the country. It's about 2% unionized. Obviously weather is an advantage, and I don't really see the Northeastern and upper Midwest states changing those competitive advantages anytime soon. I do think there are other states outside the Southeast that are highly competitive when it comes to corporate relocation. So when I did work for the state of North Carolina, I mentioned that we competed with other Southeastern states. There's also a lot of competition with a state like Texas, for example. You've got at least 3 very fast-growing markets in Texas, although I think a lot of it depends on where companies and individuals are coming from. So I think you've got a lot of people leaving California, moving to places like Texas and to some degree Colorado and Utah. If you look at that U-Haul index, it costs something like $1,000 a day to rent a U-Haul going from San Francisco to Park City, and $50 a day going back from Park City to San Francisco, because nobody's going to rent a U-Haul going that way. Whereas here in the Southeast, we have more companies coming from the Northeast and the upper Midwest. So I think that's the competitive dynamic, is competing with other Sunbelt states rather than a risk that a state like New Jersey suddenly becomes much more competitive in terms of corporate relocations and individual residential decisions.
Yeah, the U-Haul index, fascinating. I didn't really know what that was. I heard it referenced, but now I know. So this is purposely not competitive, but a question that it looks like that you're selling stuff and from time to time. And one would argue that holding on to real estate is often a good idea from the recapitalization, all the tax benefits and that sort of thing. So can you just comment about turnover and how you see all that?
Yeah, so it's very much case by case. We have, most of the deals we've done have been out of commingled funds where we have an IRR clock ticking on the capital on the deal. And so then we're obviously incentivized to sell. We've generally been underwriting to a 5-year hold. If we can exit in less time than that with a strong IRR, we will. Sometimes it makes sense to hold longer. I mentioned that office and retail asset in Wilmington that just stays fully leased, cash flows very strongly. There's really not a reason to sell that. As I mentioned, as you suggest, Arthur will recap that and get investors most of their capital back without actually selling it. But to the extent that investors are interested in running assets long-term for the cash flow rather than on an IRR basis, we see all of those deals. We've done plenty of those deals. We just need to do them generally outside our commingled fund. And in that case, what we do is we put together an ad hoc club of investors who are comfortable owning the asset for the long term and running it for the cash flow, as opposed to the IRR hurdle that we've got within the commingled fund.
Fair enough. Can we talk about the performance to the extent that you want to talk about that, and then what a K1 might look like? And I know you're not going to give tax advice, but whether you structure it in a way to get some of the goodies for real estate to pass through to the LPs?
Right. So we've been targeting 12 to 14% returns. That's obviously a blended return since we are so diversified. Our stabilized office and retail asset in Wilmington underwrites to about a 12 on a 5-year hold. A ground up hotel development deal like the one we did in Nashville with the Hyatt House obviously needs to do a lot better than that given the risk profile. We're showing an 18.2% IRR on our fund currently. We will do better than that on the assets that we're realizing now, but that includes projections through business plan for our unrealized assets. And in general, we're just trying to deliver the appropriate level of risk-adjusted return for a given deal. Our fund is structured as a limited partnership, so it's a pass-through. Investors get a K1, they get the benefits of the depreciation, and there's no taxation at the limited partnership level. And again, obviously, to the extent that we put together ad hoc clubs for a given deal or a series of deals, it would be the same treatment.
And the fee structure and pref and catch up and all that business?
Yes. So we have what we hope and believe is a very simple, very clean fee structure. We charge a 1.5% management fee, and that's charged on committed capital until the end of the 3-year investment period, and then it steps down to being charged on just on invested capital. Most funds we see out there, particularly those that are aimed at family offices, have lots of other fees. They have acquisition fees and disposition fees and financing fees and asset management fees. We have no other non-performance-based fees besides that 1.5% management fee. And then our promote is 20% over an 8 with a 50-50 catch-up. So again, we've worked hard to make the structure as simple and as clean as we can. Those are the only 2 fees in the structure. No other hidden fees or anything else embedded.
Great. So what's the target for the raise, and how far along are you?
So we've raised $106 million since inception so far. Much of that is deployed or out with a new vehicle now, and we're trying to raise $250 million, of which we are about a third of the way there in terms of commitments and soft circles.
And the folks that have, without disclosing who they are what do they look like?
So we have
family offices?
An institutional investor who is our anchor, a North Carolina-based insurance company, and most of the rest of our investors are family offices. We do have one university endowment committed, and we have one other soft circled, as well as a couple of foundations. But the bulk of our capital has come, and we think will continue to come from family offices.
Great. So, Lee, that was, I don't know how you could have bettered the first one, but you just did. Thank you for.
Thank you.
So if, while we're waiting for any final questions, of course, we'll make sure you're in touch with everybody that was registered and on the call. You want to just wrap it up with a final comment?
Sure. Well, I very much appreciate everyone taking the time to hear more about our story and what we're trying to do here with SharpVue Capital. We believe strongly in the future growth of the Southeastern markets. I think you are seeing, in terms of macroeconomic conditions, the reasons for that continued outperformance. I think the pandemic has accelerated that outperformance, and I think for SharpVue, being physically in these markets, being closely networked, deeply embedded, we're extremely well positioned to take advantage of this long-term secular trend of Southeastern outperformance. So we very much appreciate your time and attention and look forward to following up.
Great. Thank you, Lee, for doing this again for
Thank
us.
you.
Certainly appreciate it. Good to see you. And all the Family Office Insights members and friends and friends of friends, thank you for being part of the community and joining us here again. Excuse me, and sharing, as I often say, the only thing that you can't make more of it, and that's your time with us. So until next time, thank you. Thank you, Lee.
Thank you.
Bye-bye.